if we can get him up on stage.
Yeah, I've chatting to him privately, so just don't want to put him on the spot. But Mark, yeah, if I've sent you a DM, if you could join, it would be great.
While we're waiting, it's worth looking at so obviously the Bitcoin volume, going from USDC to Bitcoin is
perspectives. From a small startup perspective, it's going to be very, very painful. I'm seeing it. I'm having to fund payrolls for multiple of my companies that have done business with Silicon Bank. I think the unknown that will impact what everybody has said is what the advanced dividend is going to be. And let me just add, the term advanced dividend needs to be better explained in their press release. And I think it's something that people don't understand. And I know I did not understand when I started reading it, and I had to, be corrected in some of my tweets. But, how much of uninsured deposits are returned to companies on Monday, Tuesday, and Wednesday is going to drive the entire response on this. If it's 50%, 60% across the board, so if you had 10 million in and you've got 5 million back, then all of a sudden people are going to have some confidence that the system is working. If it's 10% or less, then people are going to question how the process is going to work. And so I think that's going to be a big driving factor. In terms of the macro impact, I went through this in 2000 and, I've stopped investing at some of the crazy valuations over the past 2 years. What we saw in 2000 in the public markets is exactly what we've seen in the private markets in terms of valuations. And so I think this is the chickens coming home to roost in some respects. It's going to be more difficult to raise capital even for great companies going forward. So, that's just a lot of generalities, but that's kind of where my head's at.
So, Mark, in terms of the long-term contagion effect right now of this, as it affects not only the startups whose money is stuck in SVB, but the startups that work with them and so on, in the second and third order effects, are you concerned that this is actually going to have a bigger effect than people are currently, even on stage, arguing that it will not? Will it be all self-contained, or do you think there's going to be a contagion effect here?
Depends on the advanced dividend. So if nobody gets anything, then it's a huge contagion. Payrolls aren't made, vendors aren't paid, and those vendors, when they don't get paid, they can't pay their payroll. So there's a second, third, and fourth order that happens, every 2 weeks effectively for payrolls. And so if there's no money paid out in advanced dividends, we have a problem. If there's a material amount that covers enough, that allows enough of the startups, enough of the wine industry, enough of the companies' impact to pay their bills, and make their payroll, then I forget who said it, but 6 months from now, we won't remember the details.
That was me, Mark, and I think Daphne's important point here is that she's handicapping based on these three really good sources that up to 50% will be available this week, which was my view as recently as last night when I was looking at this. I said, look, there's enough assets here, and there are enough. It's a relatively small bank compared to the majors. There are plenty of majors who've long wanted a foothold in Silicon Valley. They've long wanted to bank the Stripes and the Squares and the up-and-coming tech companies. This is actually their opportunity. And the same way that Apollo saw when Airbnb was shut down during COVID, they're like, look, this is a 40% margin business with a great business model.
For sure. And I'm not going to lie and say it didn't cross my mind to say, okay, who's going to be desperate and where can I pick up some scraps and invest in good companies? Just like in 2000, buying Amazon and Dell and other companies when all the companies are getting hit, or, buying Live Nation in March of 2020 when, who knew how long the pandemic was going to run. But that only is going to be available to a select few, because they're private companies, and not everybody's able to take advantage of that. So, It really is going to depend on how much the advanced dividend is. If it's 50% and you get that by Wednesday, okay, because Wednesday's the 15th and maybe payroll's a little late, but that covers payroll for at least some percentage. And then the next question is, how well do they communicate what's happening for the other 50%? If it's all uncertainty and we don't know any type of timeline and there's no ongoing communication, that'll create a smaller contagion, but still a contagion.
So, Mark, 2 questions then. Number one, how are you playing? You just mentioned a little bit about how you may play offense with potentially picking up scraps for companies that are struggling. But can I also ask how you're playing defense for your existing portfolio founders that may have exposure to SVB?
Oh, I'm writing checks. It's that simple.
I mean, you're covering the bridge either way.
Yeah. So I'm only exposed to maybe $8 to $10 million. So it's not, for me personally, I'm fortunate. But like costplusdrugs.com deals with SVB. And so we had, I think, $3.1 million there. And so we're scrambling and opening up accounts and staying up late talking to bankers to get accounts opened up at other banks. And, I'm writing checks on Monday morning first thing to make sure that payroll and payables are covered. And, because this costplusdrugs.com is, my baby right now. I'm not letting it go anywhere. And so, I'm playing offense in every way that I know how. But it's, I think it also was mentioned that there's complete uncertainty. Let me take a step back. Of all the things founders have to think about, when you assign a probability to bank runs, it's rare that anybody's going to assign a probability greater than 0. And so it's, I can't say you can blame anybody. And even SVB, when they're assigning probabilities to bank runs and high-profile VCs telling all their companies to yank money from SVB, nowhere do you assign a probability that $42 billion is taken out within 8 or 10 hours or whatever it was. And so this really is a confluence of events that nobody would have predicted. And so those are the types of situations where you hope the government comes in. Now, I don't call it a bailout, and some people gave me a hard time of that, simply because I think there's good assets. And if you're buying good assets and that solves a liquidity problem, okay, that's not a bailout. That's, I think, like was mentioned before, just taking care of the liquidity side of the problem, and your risk is the interest rate delta.
So let's talk a little bit further about how you're counseling the existing startups in your portfolio. Are you telling them to evaluate all of their vendors currently? Should they have, fiduciary duty is to make sure your company is going to continue and you're not going to have interruption in service. Are they all looking through all of their vendor lists and saying, hey, who's got SVB and what should we do?
It's too late. It's too late for that. Yeah. And so, and again, shit happens. You couldn't predict the pandemic. And so you couldn't say, well, why didn't you have, have this done or that done? I just don't think that, as much as some people might want to claim otherwise, no one's predicting this. I don't care who you are. I don't care how big a douchebag the CEO is, right? I don't know the guy. I know the SEC did change the laws on the terms of the automatic sell program, so it'll be interesting to see what happens there. I do think it's going to be interesting when we find out if any of the VCs that were actively telling people to withdraw their funding were also shorting at the same time. I don't know what the legal ramifications there are, but that'll be interesting. But there's nothing, sometimes people hit a 94-foot full court shot, and, you just tip your hat to them, or in this case, you just, shake your head and go on about with your business.
Hey, Mark, can I say one thing on that, Mark? And
sure.
I think you're right that nobody within the tech landscape and not a lot of founders were aware of the issues here, because founders don't sit around analyzing bank balance sheets and trying to match the held to security maturities with the equity and trying to figure out the difference between those and the available for sale securities. But it turns out that there were a lot of people on Twitter, including, again, Raging Capital Ventures, who did a full analysis of the balance sheet within the last few months and pointed out that he thought that the Silicon Valley Bank was basically insolvent. Now, look, the central bank is insolvent right now, but of course they can print money. The problem is smaller lenders can't. So
but
like,
there's
I
a difference
just want to push back on. I just want to push back on the idea that.
Oh, you just dropped it out. Go ahead, Mark.
Yeah, I was just going to say, I know where he's going, and I'm not saying nobody understood it, and I'm not saying that there aren't lots of analysts who look at banks and any company for that matter and look to see what their risk factors are. But the only way that there's a difference between their equity declining and their stock price declining and the idea that they were going to become insolvent. Well, they aren't. Insolvent's the right word because for banks, as I understand it, you don't have to mark to market. So on a mark to market basis, you're insolvent, but on a legal basis, you're not, right? So that's part of the confusion. And so the issue wasn't whether or not they were insolvent on a mark to market basis or not. The issue was, would there be a bank run? Because many a bank has been underwater on a mark to market basis, but as long as there's no bank run, they could just hold to maturity and things would work out. And that's what's happened historically, right? Because when you look at the banks that have less than 25% of insured deposits, all of them at some level have that risk. But not all of them, as was mentioned earlier, are so concentrated. And so had, Peter Taylor or whoever, I'm not blaming Peter, but whoever, the idea that the bank run is a you could assign a probability to a bank run. I just don't see that as being realistic, and that's the difference here, and that's what that closed Silicon Valley Bank.
So, Mark, one question that comes up is last week when Moody's warned SVB about this. How much does this come down to the leadership at SVB? If you actually look at the article from CNBC, they also mentioned that SVB actually got General Atlantic to put in $500 million, but then were unable to get the paperwork done. I mean, this is unreal. Before the markets opened, they couldn't get the disclosures done, and so everything fell apart. Is this just sometimes this kind of stuff happens, or does this now warrant the government to come in and shore everything up to fix it?
Well, I mean, look, all the above, right? General Atlantic was only going to put in, $500 million?
Yeah.
That was a pimple on an elephant's ass relative to what was going on, right?
Yeah.
And so, it wasn't going to change anything. And as the price kept on falling, you've seen these death spirals in public company stocks before as they're trying to raise money selling their stocks. So that's not unusual. But again, it was the concentration of control by, very powerful VCs, because by definition, think about the bigger picture here. So by definition, Silicon Valley Bank was loaning money to the investments of the biggest and baddest, if you will, VCs in Silicon Valley, right? So they had a huge amount of dollar concentration because they're bigger, better companies. And there's a huge number of them because these are venture capitalists that are very big. And so it didn't take many demands from the VCs to pull your money out to trigger this bank run. And so it wasn't like, It's a Wonderful Life and George Bailey is standing outside handing out coffee and there's people waiting in line and you just close the doors. This was a huge concentration of $42 billion in 10 hours. You know how insane that is?
Yeah.
Mark, do you think this is the Fed playing chess and sucking the froth out of the speculative private equity and venture capital market?
Yeah, but they didn't see this coming.
Yeah, no.
Mark, I totally agree with you that the bank run was unprecedented. We never saw the scale of withdrawals and the fact that the tech community is so well connected that they were able to move quickly, get the money out. I mean, so many companies got money out Thursday morning. It was crazy. But so I agree with you. What I said earlier on, I'm not sure if you're in the room when I said this, but I think the Fed should step in and buy these mortgage-backed securities and just hold it to maturity.
Yeah, of course.
It's a no-brainer. That's what they absolutely should do right now.
By definition, since you didn't have to mark to market, that was a tacit approval by the Fed that you should hold to maturity, right?
Exactly.
So the Fed should just step into the role that they were asking, that they tell every bank to take, right? Hold to maturity.
They're sitting under $1.5 trillion right now on their own securities on their balance sheet, and that they're holding to maturity, and they're not marking down because that's their policy.
Well, yeah, some people would say two wrongs don't make a right, right? But still, at the same time, all you're doing is acting as a liquidity backstop. That's all we're asking for the Fed to do, right? Now, is there interest rate risk associated with that? Yes.
I think this happens so quickly. What we saw in the financial crisis, before a bank or broker was put into receivership, there was already a deal in the background in place, like a Bear Stearns, JP Morgan, or say like a Washington Mutual, JP Morgan as well. But the problem here is that this $2 billion, think about it. I know it's a lot of money, but Silicon Valley Bank just tried to do a $2 billion convertible capital raise, and it failed on the market. And then the bank run just took speed, and it was done.
To be fair, they did that during, just to give more context, they did that as Moody's was downgrading them. That it's not.
Now remember, $2 billion. If I read the numbers in the articles right, they were only short $956 million.
Exactly.
Yes, that's correct.
But again, in the middle of when Moody's was saying that you're about to get a large downgrade, and so I do want to on their credit, and so Mark, one more question for you on this, because the political ramifications are critical. You guys are saying now. Vinny was mentioning about how you could just buy the Fed could come in, buy the mortgage-backed securities, take it to maturity. But the question is, if this happened, wouldn't there be a good, beautiful narrative around, hey, they're bailing tech out because tech bailed them out, all about elections, all about the Twitter files, all about all of this other stuff that has come out recently about how the government and tech have been working together? Isn't that the real reason why this hasn't already happened? I mean, if this happened in any other industry...
No, I don't think that's the case, because the Fed, or the FDIC took it over on Friday, less than, 24 hours ago. And so you've got to give them a little bit of time. But you're right, they'll be battling narratives. And the interesting part will be, how the Democrats and the Republicans try to figure out what their appropriate narrative is, because they probably want to do the same thing, But the right narrative, I think, and this is just my opinion, is that the equity holders, the investors, if you will, the equity holders, the bond, let's limit to equity holders, got wiped out. And what was the market cap of Silicon Valley Bank a month ago? Anybody know? I mean,
I can
100 billion?
100 billion-ish, yeah.
Yeah. So the right narrative is investors who weren't paying attention. The people who actually own the stock are the people who are supposed to be paying the most attention, and the funds that own them and the brokers that recommended them, they lost $100 billion.
Absolutely. And debt holders as well.
And that's what I said to you earlier, and Daniel said exactly the same thing. Mark repeated it. That's exactly the
other thing, Mark.
Right. So that's the narrative.
The other thing is that we already have, we have precedent. Last October, the New York Fed opened up swap lines with the Swiss National Bank to bail out Credit Suisse's outflows to the tune of $20 billion. And in 2018, with the reverse repos, many would argue they bailed out JP Morgan and every other too big to fail bank. So we need to grow up. People got a lot of losses, bondholders, equity holders. You're making a VC community whole, no different to
Well, I would never say you're making the VC community whole. That would be the worst narrative.
Right, I apologize.
Ever.
Just making the small SMEs that have their only deposit in America there.
Yeah.
Right.
No one feels bad for the Patagonia vest wearing VCs. I promise you.
Right.
It'll be
and why
really
they wear
hard.
them, I have no idea. But at the same time, all those employees and the second, the second level, right? The payables that they don't pay and the vendors that don't get paid and the employees they have to lay off. So the second order, third order, fourth order is what's at risk here. And that's what really needs to be paid attention to. But the headline needs to be 100 investors wiped out by $100 billion, whatever their market cap was a month ago.
Well, let me say,
because then people feel like, because then every day, regular people, if you will, horrible term, but feel like, okay, somebody got torched in all this. The people who deserve to get torched, that should have been the most vigilant, did lose their money.
It's not. So the market cap at the close Friday was $6 billion, and that's at a price of $100. So,
so three times that's 20 billion. Okay, so 20 billion.
Yes, exactly.
Okay.
Hey, Mark.
Okay.
Mark. What do you, Grant Cardone? How you doing?
Hey, Grant.
What do you think the effect of Roku is on Monday, having 280 billion over there, and the negative impact to other banks in the region?
So I have no idea on other banks to the region. In terms of Roku, it depends on what the advanced dividend is. So if the FDIC says it's 50%, it's going to be paid by Wednesday. Okay, Roku gets, half of it back. And then depends on how much they communicate from that. If they leave it open-ended, then that is a risk factor for Roku. But no one's going to think they're going out of business. So it just becomes as if Roku, the right way to look at it is Roku lent the FDIC, or lent, literally that's what a deposit is, lent SVB whatever the delta left over is, that amount of money, and depending on the communication from the FDIC for advanced dividends, that's the term of the loan. So then Roku has it on their books as a loan with that term on it, with the FDIC as the guarantor, if you will, an indirect guarantor. I don't know how you would account for that. So I don't think it's a huge negative, but I'm not going to try to speculate on what the stock market does or how they respond.
And then, Mark, what is the lesson for people with big individuals or companies with big cash reserves? Where do and how do they protect it? I know there's the ICS mechanism, but where do guys and companies rotate money?
I'll tell you what I'm telling myself and everybody else. Shit happens, right? Because the reality is you have to be for a bank run like this to happen, you have to be in an environment where rates are rising quickly, significantly, and somebody has the term mismatch so they can't get liquidity, and then there's a bank run. That's just not going to happen again, or hopefully it shouldn't, probably because we're already at, a much higher interest rate level, and how much higher does the Fed have to go? 1%, 2%? 3%,
well, that's actually a
right?
Mark, I might challenge you on that point, Mark. I think that next week, if this issue isn't resolved this weekend, you will absolutely see bank runs happen on other banks. So if, for example,
I'm not saying that. I agree with you. I think that's a possibility. Well, you're right. I'll change what I said. You're right in that Signature, and that's wrong to mention a name, but any of the low insured deposit percentage banks, if the FDIC doesn't communicate well on their advanced dividends, and even what an advanced dividend is and what the payout and return is going to be for deposits, then all those other banks are at risk. But I don't think they have the concentration to be able to generate a true bank run, because I just don't see it being analogous to what happened to SVB.
But the other side of it,
there is some PTSD right now. I mean, everyone
for sure
who wasn't with Silicon Valley Bank is thinking, oh my God, like Monday comes, if this bank's in trouble. I mean, as the stock, hedge funds come in, they start shorting bank stocks, they can trigger bank runs, and they can make this happen because, oh, look, this XYZ bank is down 50% today, I'm taking my money out. And that can.
Well, then if you're the Fed, you just say, look, we're backstopping all these banks.
Exactly.
So the other side of it, outside of backstopping the banks and being communicative about dividends, how do you think, they're having an emergency meeting on Monday. I'm sure you heard Jerome Powell is calling an emergency meeting on Monday. Do you think that this changes the posture for the Fed in terms of rising of interest rates and even, switching maybe from a hawkish to a dovish posture on?
I have no idea. Right. I'm not smart enough to be able to figure all that out, and I don't model that stuff. I just try to help entrepreneurs run companies.
Mark, what about the USDC side? I know you probably got bigger fish to fry, but what do you see? No,
I've got a lot of USDC actually, and I've seen what the pricing has done, and I'm not an investor in Circle, but I know Jeremy, and I hope things work out. But again, it just comes down to how the advanced dividend program works. Because once they're able to get access to that capital, then, and I'm sure Jeremy is going to be, distributing to a lot of different banks. So just to build confidence. So I think USDC will be fine, but, it went from being a 99% assurity of it, being risk-free to, a 95% assurity.
there's 2 points here. The one point is whether it's USDC or Circle or banks, if there's sufficient equity in the entity that they can take a dilution and shore up the balance sheet or plug a hole, things should be fine. I think that is the case with Circle, most likely, and it's probably the case with some of the other banks. Depends on how deep they were in the losses. So I think it's probably okay from my perspective.
But if banks,
yeah.
I was going to say, but if banks are having to plug equity holes like that, then that's a reflection of bigger problems.
Well, that's the problem. The problem is the Fed's monetary policy was, post-COVID, is just like they reduced the ratios required for deposits. They made it super easy for banks to just plug liquidity in the market. Then they took it all away in within months. And the banks are like, well, hang on, we were buying 3-year mortgage-backed securities on the hope that this stuff was good for 3 years, and now within months, it was ripped away. And Powell gave no guidance until after he was,
Yeah, but remember, monetary economics is not a science. It's as much art form as anything. Going back to 2008 when, Bernanke used to wonder how he could do helicopter drops of cash.
Exactly, yeah.
And so, they guess as they go and they monitor continuously. And it's like running any other business. You go based off of what you know until something changes and you have to adapt. And I just, we all can cast aspersions and look at models and look at, historical things that have happened historically and try to point to those as an indication of the future, but none of us are good enough prognosticators to really predict.
So you were mentioning that your job is to help founders and entrepreneurs build good companies. What do you suggest to an entrepreneur that was not involved with SVB? Sorry, this is very self-serving. Was not involved with enough not to have their money in SVB, but right now, would you say, hey, pivot even harder to profitability because the VC market is now going to slow down even more? Or is it, let's play offense and let's go?
Hey, I've been a pivot to profitability guy for the last 10 years. Unless you have a direct path for growth where that you're going to be able to grow and get to profit, and you have a direct path to profitability, you're not, I'm always, and this is why I haven't been big in Silicon Valley. I've never been a fan of raising 200 million to generate 100 million in sales. And so, I've always been a proponent of get to profitability and grow as organically as you can, unless you just have something that's so differentiated that you just have to move quickly and grab as much market share as you can, knowing it'll be profitable, knowing you can turn on the profitability at any time. And so I've been very, very forceful with all my companies, regardless of size, to get to profitability and to grow organically, because the VC valuations were so high, it's going to be very difficult for those companies to raise. And where they do raise, and particularly now since debt's going to be even harder to come by, when they do raise, it's going to be down rounds, and founders are so resistant to that, and that creates cultural issues within the company, et cetera, that it's better to be slow and give up growth and be profitable and control your own destiny. And that's been my position for a while. And that's why, I don't have a big hit with SVB, because, the deposits were there, like I said, to 8 to 10 million, but, we really didn't have any debt at all with SVB.
Do we see a lot of acquisitions in the next few months? Is that going to be the average?
Yeah.
Like, is that just a for sure that there's going to be a ton of acquisitions?
Yeah. Cash is king. Everybody is seeing it. A lot of people, I should say, emails every day asking to buy stock in private companies at a discount right to the last round. They're just fast and furious in the secondary market. And to me, that's an indication. So I think, anybody with capital right now is going to be cherry picking companies that are cash poor because they didn't get enough back from SVB with their advanced dividend, or they can't wait. So I think that's going to be a big opportunity. I think companies that can't get the round done and they need capital, you're going to be able to name your price for a lot of companies, and then a lot will go out of business. And that's just the unfortunate reality.
Is this better?
It's worth pointing out.
Sorry, Benny. One more question for Mark.
Go ahead.
Yeah. I'm sorry. I don't want to dominate all this. You guys are a lot smarter.
Yeah, I think they're enjoying it. Vinny, go ahead, man.
Mark, yeah, so one of the things that's worth pointing out to everyone as well is that there are already hedge funds and brokers that are contacting people who've been affected to buy the deposit. So there's an arb that's going on where they're saying we'll give you 65 or 70% of the money that you have in, and we'll take the risk on collections. And because they've done the math and whatever. That is actually a viable option for startups or people who need the cash and just take the haircut and move on.
I mean, it's an option for sure, but just realize, the ARBs aren't dumb.
No, I agree. Only if you dare. Maybe it's wait till Monday, see what that number is, whether it's 50%.
You have to wait till Monday. You have to wait till Monday and see what that number is. I mean, it's like factoring anything else. I mean, when you're factoring your sales, when you're factoring, your inventory, whatever it may be, that's always the worst thing to do unless you absolutely have to.
I mean, let's assume you get 50% back on Monday and then you're able to sell the rest for 60% or 50%. You're only down 25% on your cash. That's a lot easier to stomach than basically.
No, 25%. Think about that. 25% of your cash.
That's a lot.
Mark, my point is that, like, if someone said, hey, you get 75 or 80% back of your cash, you can probably like cut costs. You can figure out how to make the company survive. But the money being tied up for years and not being able to access any of it is disastrous.
See, I would tell you that it depends on how well the Fed communicates or the FDIC communicates, right? So if there is a really in-depth communication where they lay out, so what was it? $73 billion is their loan book, right? And we estimate that there is a 8% failure rate, right? So we'll lose on 8%. And so based off of that amount, that's 101% coverage of between treasuries and their loan book. That's 101%, but we won't be able to sell them for an estimation because the term of their loan book maxes out at 6 years. That's the worst case. We anticipated 3 years. And if it gets below this number, we'll just cover it, right? The more in-depth their communication, the better decisions that everybody who is involved will be able to make. So it's the quality of the communication that's going to matter more than anything come Monday.
Hey, Mark, I had a question for you real quick.
Sure.
This is Adam Quabasi, a big fan of your work. I know we've engaged a couple times on Twitter, but I think one of the big problems here is a lot of this collapse was a product of human behavior and almost like a lack of confidence in the system. And it was, I feel like you need some sort of way for confidence in the system to be restored after this. And particularly, I think one of the big problems is the FDIC insurance of $250,000. I know you've talked about this and tweeted about this. That's great for, your everyday person that's putting $50,000 in the bank and, you're reassured. But 97% of these deposits at SVB were above that threshold. So going forward, what can we do to reassure, even your companies or companies you've invested
of course.
in to have confidence in the system and get things running again? Because right now, everyone thinks that we're on the brink of another major collapse, and it's going to be very hard to turn that around in this macroeconomic environment.
No, I agree. $250,000 as the max for insured is insane. But, the reality is there's a de facto insurance just by the fact that the FTC came in and didn't just let everything collapse, right? And so they have to be more clear on that, on how all that works. And I suggested to somebody, and I know this will never happen, so it's pie in the sky, that banks publish a daily index of their risk factors, right? So if Silicon Valley has only 2.75% insured deposits and 97% uninsured on a mark-to-market basis, what's the ratio of uninsured to their assets, right? To the liquid value or mark-to-market of their assets. So in Silicon Valley case, it probably went from 1.15 and very quickly got down to 0.6, 0.7, 0.8, whatever it is. But if you're publishing that on a daily basis, at least companies can start making decisions based off their risk factors. But beyond that, there's got to be a policy that says, I guess if I was going to be truly draconian about it, I would say that they have to publish more stringent rules and requirements for the banks, and rather than the CEOs of those banks being at risk civilly, there's got to be criminal penalties. But that'll never happen, right? There's just too big a lobby for that to happen.
Mark, let me ask a question about, hold on guys, just about crypto. We saw what happened with Luna, we saw what happened with FTX, all the FUD around Binance, constant FUD around Tether, and now USDC depegging. What's next? What do you expect over the next few months, and what's your thoughts on the movement towards CBDCs?
So CBDCs, there's enough countries that are dabbling, so they'll be the proof of concept, and we'll see what happens there, right? So if that works out great and the efficiency's there, like people hope, then they'll become more prevalent around the world, and the U.S. will have to do something at some point. In terms of crypto in general, people might not like to hear it, but we're in a lull. We're in a holding pattern until there are new applications that create utility, so that people who are non-crypto have a really good reason to go to crypto. We've seen the adoption of DeFi and some of the value propositions there. We've seen NFTs and the value propositions for collectors and some other applications for NFTs. We've seen some applications with smart contracts that are good, but we haven't seen, we haven't had the Instagram, Snapchat moment that the iPhone had, where people like, okay, it's just a phone with a camera to, oh, okay, there's applications I really that I really want to use, so I'm going to buy an iPhone. We haven't seen that utility-based application or that general usage application. And unfortunately, and this is the real problem for crypto, most of the development is still being done on technical tools or finance-related tools or NFT-specific tools, and nothing is there's some minor efforts to be, general usage applications or non-traditional crypto utility applications, but not nearly enough. And until that happens, crypto is going to be in a lull, and there's not going to be anything spectacular there.
What about Bitcoin as a mechanism for removing bank counterparty risk?
I don't see it. I don't see it at all. You could, I know you could hold your crypto in a cold chain, but you can also hold cash.
All my Bitcoin is good right now.
Yeah, all your Bitcoin is good, but it's still only as good as people are willing to pay you cash for, right? And so, people, if you have a lot of Bitcoin, someone's going to have to borrow money, or they're going to introduce the time value, their interest rates that they'd have to pay to borrow the money to buy your Bitcoin. And so, you look at what happened in Nicaragua, and until it just didn't take off because it wasn't easy enough. And so while I see Bitcoin as a store of value, I think it's a better store of value than gold. And I own Bitcoin over gold all day, every day. And some people disagree, some people agree. But it's still, its utilization really doesn't happen until it's converted to dollars or some currency. And so you still have all the risks of those currencies associated with it.
Yeah, so separating spending and saving.
Let me read out. Go ahead, Simon.
No, just saying separating spending and saving is a mechanism.
But as long as, unless you can be organically Bitcoin, so you can earn Bitcoin and spend Bitcoin in Bitcoin, it's always going to have to be converted. And
that will never happen until it becomes a bad currency and it goes down in value, because that's what makes you spend it. If it goes up in value, you always default to fiat.
Yeah, right? Of course. Right. But that's like gold. And gold, the narrative on gold has always been a hedge to inflation. It's not a hedge to inflation, right? Easy money, buy gold. Who's that old school actor that always comes on all the commercials, right? And so Bitcoin is in the same mode. I just think Bitcoin has more utility than gold. And look, even gold is all traded digitally. Nobody actually owns gold unless you own coins. And so, they're two versions of the same coin. I just think Bitcoin is better, but I don't see it as the panacea against fiat.
I've just DM'd Bill Ackman to join, but I want to read out a tweet he just did. I retweeted it on my account. Let me open it again. I'm just going to read out the first two sentences. The government has about 48 hours to fix a soon-to-be irreversible mistake. By allowing SVB to fail without protecting all depositors, the world has woken up to what an uninsured deposit is, an unsecured illiquid claim on a failed bank. And they continues, very detailed thread. I've just sent him through an invite, waiting for him to reply. But if no one steps in, if the government doesn't step in, what could happen over the next few months, Mark?
Well, they've already said they've stepped in, right? That's the whole term, advanced dividends. So they already said they're stepping in. The question is to what extent? And if what was mentioned before was true, that the first pass is 50%, okay, that's a little bit of breathing room. But, if your payables account and your payroll account are only being reimbursed for 50%, you still have a hole. So the question becomes, what do they say on Monday for the rest of it? And like we discussed earlier, I think the smart thing to do is to be the liquidity provider, to step in as liquidity provider for Santa Clara Bank for deposits, because that removes all that contagion risk.
Mark,
right, Mario,
Mark.
I think the biggest point that Bill Ackman was making was that if you don't fix this today, over and beyond what Mark just suggested, right, with the advanced dividend, then every single person is going to want to pull out of mid-tier banks and go into SIVBs, basically go into systemically large banks. You are further and further concentrating the banking system. Right.
For sure.
And that's, and I think it's a tragedy because, as Bill Ackman says in that tweet, Mario, that he's a very financially sophisticated person and he has no clue, what the systemic risk of each bank is on thousands of pages of filings. And so, lo and behold, how are the general populace going to gauge this? I'm telling you, this is really horrible. Go ahead.
The general populace is going to look at it like, oh, I can't, like Giannis looked at it. I can't keep more than $250K in any account. Mm-hmm. But the overhead and costs associated with that, it's going to cost you more to do that than you'll earn in interest. So it'll be deflationary.
Just
Mark,
remember back in 2008, the FDIC limit was $100,000 only, right? And because of the financial crisis, they raised it to $250,000. So even if we go through another banking crisis here, there'll never be a situation where they have all deposits are insured. The government just is not going to do that, because the message that'll send to the bank management is they can take on more risky type of investments, and I just don't see that happening.
But depends. So, but what they can do is, I guess in the last administration, they changed the rules in terms of it's $250 billion above which you have to adhere to all the Basel rules, and below that, Silicon Valley was just underneath that. So they can lower those standards again so that the risk mitigation is greater. And I think that needs to be a first step, and I'm guessing that's what they'll try to do.
Mark, do you see a way where Silicon Valley could solve its own Silicon Valley Bank problem without the FDIC?
I don't know why they would, right? Because I think they would rather put the money to work elsewhere. Because, again, if you think of the accounting side of it, those deposits that are held now by the Santa Clara Bank that's operated by the FDIC are loans from the depositor to the bank. So that's an asset by definition on the books of all those Silicon Valley companies. And so it really comes down to, where am I going to put my money? I'd rather put my money in the best companies that need capital quickly than trying to take on the Silicon Valley Bank obligations.
Exactly. And then, Mark, one question for you, because you were talking about the best companies. Let's talk about the best sectors right now, because this is obviously, as many people know, SVB had a big interest in the fintech side, but also on life sciences. Are there certain sectors that you're like, hey, there's going to be more of an effect in these sectors versus others? Like, which sectors are you worried about within the tech ecosystem?
I think everything built around life sciences is huge upside, huge risk, right? And not just about, whether or not they succeed in trials and the like. I just think, the reason I started costplusdrugs.com, and I'll do my little sell my book here, where right now we sell 1,100 different generics, but what we do differently is when you go to costplusdrugs.com and put in the name of the med you take, we'll show you our cost, we'll show you our markup, we'll show you our pharmacy fill fee, and we'll show you the shipping so that there's complete transparency. In the entire life sciences business, in the entire pharmaceuticals business, in the entire healthcare business, there's zero transparency. So I think that the winners are going to be companies who differentiate through radical transparency. The more transparency you're able to offer, down to, hey, if you give Cost Plus Drugs enough business, if you're a Fortune 10 company and you buy all your medications that we carry through us, I'll give you a log on to my accounting system, and you can look in every day at my inventory and my accounting. Can't change anything, but you can look to see the day-to-day changes in my operations. I'm fine with that.
In the pharmacy delivery side and pharmacy fulfillment side, totally agree. The question on life sciences, though, is as you were mentioning earlier, you have talked to all of your companies that you've invested in, companies that you lead, that, hey, we're going to pivot to profitability. How does a biotech company pre-FDA approval do that? They're relying on SVB and banks like that. Who's going to put in the money so that we can get more drugs, so that those drugs can then be provided to patients? Sorry, I'm a doctor. So
but that's a whole different conversation, right? Because there's margin rights and the like. So I think there's money available. What did I read years ago? That of the single molecule drugs, 113 out of the last 116 through 2016 were funded by the NIH at their foundation, right? Yeah. And so going to the whole transparency element, if I'm a life sciences startup and I'm going to the NIH, I'm going to negotiate a little bit differently. I'm going to give up some of my upside and pull a page from Silicon Valley Bank, if you will, and give warrants to the NIH and give shares to the NIH in exchange for that funding, because I think the government needs to start thinking more about America Inc. and representing taxpayers as if they're shareholders and asking for rewards for the money that they invest, which, you know, like we saw with the semiconductor industry with the CHIPS Act, you know, where they shared in the upside. I got no problem with that. I'm still taking their money if I'm a semi company and I'm bringing it to the United States. You know, sharing in the upside and being transparent about everything, I think, is the new approach that life sciences companies and other tech companies need to take to get government money, so that they can say, and the government can say, yeah, it's tough for us to pick winners and we're probably going to pick a bunch of losers because that's the nature, but we're already investing through the NIH, but now we'll invest more because we're going to share in the upside.
Mark, I had a question for you, and then it leads into what you just said.
I feel like I'm writing a book here.
You should be taking notes.
We all have a lot of questions, Mark. Joe, go
That's
ahead.
okay.
You mentioned
fire away. Why not?
You mentioned America Inc., right? And that's kind of my worry here. Is SVB is really important to tech startups. It's where innovation comes. It's what sets America apart. We lose a bank like this, or we lose that structure. What do you see happens to America Inc. in terms of competitiveness?
Depends what the FDIC does. So if there is an unstated but implied insurance for uninsured accounts, which is what those advanced dividends will tell us, then nothing really changes. We just look at what happened with Silicon Valley Bank, and, you know, smart people like Bill Ackman adjust, and all companies adjust in where they put their funding, and the cost of capital changes for banks to raise deposits, and they'll adjust accordingly. And I don't think there's a huge impact on the tech industry overall. If there's no communication from the FDIC beyond, here's your advanced dividend, we'll let you know when the next one's coming. When it comes and it shows up at your door, then we have a problem. And then there's a lot of uncertainty. And we see that in global economics. And look, I'm way over my head here. I'm being very clear. These are all just my opinions, right? They don't mean shit. They're worth exactly what you're paying for them. You know, let's just pretend it's 11 o'clock in Dallas and I've had 5 beers, right? And we're just talking, right? But you see this on a global macro basis with China, with their Silk Road projects, right? Where they think there's needed investment in Africa and other places. And Africa is one of the fastest growing economies in the world. In India, they start putting money, even though they're borrowing and their debt to GDP ratio is worse than ours, right? But they'll put money there because that's how you develop relationships and how you build your quote unquote customer base. And so, you know, having confidence in the U.S. banking system is critical, not just to the tech industry, but to the global economy and to the U.S. as the reserve currency. And so, you know, I think Jerome Powell and Janet Yellen are a whole lot smarter than I am at this stuff, and they're considering all this, and they're just not going to take political steps. I think, you know, the politicians will do everything they can to screw all this up, but I think Yellen and Jerome Powell will do the right thing.
And in terms of other sectors, like fintech specifically, a lot of the rails were built on Silicon Valley Bank.
Yep.
You know, how do they respond now? I mean, are they?
That's a problem. Yeah, that's a real problem. Like, just going through timelines on Twitter, and you're seeing Etsy companies that can't get access to their cash. Right. The ripple effect is enormous there. Or there are payroll management companies that can't get access to cash. So payroll on companies that don't even bank at Silicon Valley Bank are going to have issues. So again, it goes right back to the FDIC taking over the liquidity of Santa Clara Bank. And I think that's going to be critically important. And again, we'll find out more. And look, if that advanced dividend, if they're smart and they set the advanced dividend at 90%, then we just said, oh, this was a fun spaces, but we really didn't need it.
Well, the chances of that are pretty low, though, right, Mark?
No, I don't know. I don't know. I think they're calling. The Fed's calling an emergency meeting, so they know there's an emergency. And so. What is the marginal cost, right, of doing it versus not doing it? How much capital? So if there's, again, I'm just trying to guess off the top of my head, if there's $117 million in treasuries and mortgage-backed securities, and there was $173 billion in deposits, we know at least 42 million of those are gone, and they're only $1 billion underwater. So that's 131 versus, who knows what's left in the mortgage-backed securities, but let's just say it's $50 billion, right? You put up the $50 billion, and then you have to say, what's the cost to taxpayers? And unless their loan book of $73 billion is really bad, then hopefully it's like AIG where the government made $23 billion, but it doesn't take 13 years. It just takes whatever the term of that loan book is. And then part two to that is you hope that the Fed, when they take over the loan book, they don't start calling those loans, because that could have a cascading effect as well. So you let them play out to maturity and go from there.
Mark, so I agree with you, Mark. But we all hope someone with your influence can just ask the following question: why did the New York Fed, advance $20 billion for the Swiss National Bank in October to bail out Swiss depositors? Like,
you're asking me?
Someone to explain that. Like, someone can just please answer that question.
Was just that is an ongoing dollar swap that they have of literally unlimited amount of dollars for other central banks who have borrowing needs that just need to plug a hole. That's been ongoing since the financial crisis.
Yeah, I don't know the mechanisms of the central banks, so I'm not the right person to.
So, Mark, I had a question. You mentioned earlier that we talk about depositors and the issue there with Silicon Valley Bank, but the bigger issue, I think, is the credit lines that all these companies have, that they're not going to be able to operate their companies, make their payrolls and whatnot, and those credit lines are frozen immediately. Right. But you mentioned your company, Cost Plus, or whatever, that you're going to step in and help that. I think other founders should be doing that as well if they obviously believe in their companies and want them to continue.
Very few. Go ahead, Mark.
Yeah, I mean, not everybody is fortunate enough or blessed enough to be able to do that like I am. And it's costplusdrugs.com. I always got to be selling. And so, but you're right. The unavailability of the credit facilities is going to have a huge negative impact on certain companies as well, right? But at the same time, for the credit worth, if the FDIC comes through and for shits and giggles, let's say the advanced dividend is 100%, then the good companies are going to be able to get lines elsewhere. It's just a question of timing.
Ethan?
Yes, I'd love to jump in here. So my company, Perlara, is a PBC, like Cost Plus, our company. Hey, Mark, you're an investor in Perlara. Yep. Good to see you on stage here. Yep. I just wanted to kind of chime in here. As an SVB depositor, this is kind of very disconcerting to see go down. But thankfully, we're one of the lucky companies that has less than 250K in deposits, because we're sort of a cash flow business. We're an atypical biotech. Sorry, my kids are in the back here. But anyway, so I wanted to kind of comment on two things. One, like, I also am on the investor side. I got, my inbox blew up yesterday with founders telling me, our funds are safe and so on. But I have companies that, have millions, 15 million. One company is tied up in SVB. So I definitely feel the pain of the founders. So I guess the first question is, like, where are we going to go on Monday? If we're shopping for banks, where do we go? I was tweeting this the other day, like, should I be looking at credit unions? Like, I don't want to go back to the big fucking banks. Like, I left those, I left them in 2008. No, I don't want to go back to them. Like, what are my choices?
Hey, when the pandemic hit and PPP was in play, I was sending everybody to credit unions. But the problem with credit unions is they just don't have the big capital base, and there's just as much risk if one big depositor walks away than what happens. And again, it's all relative to size. But if you're looking for $50 million, you almost have to go to the big banks. But do your own homework. Big banks is all relative now. What is Silicon Valley Bank was number 16. I saw one person
12.
say 19. And so, again, you're just going to have to dig in and try to make a determination. Personally, I work with Morgan Stanley, I work with JP Morgan Chase, I work with a couple other ones. And so, I've got accounts in different places, and I'll call my banker, and already have, and said, open up accounts for these guys. And so I would just, hedge my bet and open them at several different places, several different leading banks.
Yeah, this is great, because this is the advice I'm getting from all the questions I'm getting for all of the, my portfolio companies is like, where do we go? And a lot of them are in First Republic, and I'm like, or in Brex, and I'm like, why would you be affiliated with any startup, any bank that advertises itself as a startup bank? Like, isn't the contagion still out there? So I don't know. I want to shop around, but yeah, I'd love to hear more advice from people on options.
Remember, the flip side of all that is you're also dealing with the fact that once you go to one of those enormous banks, A, they don't understand your business, and B, they're going to forget your name in 3 weeks.
Hey,
Mark, I have a question.
Mark, you talked about the importance of the communication by the FDIC on Monday, but with the amount of distrust in this country right now with the government, over J6, COVID, the vaccine, et cetera, and the amount of divisiveness on the left and right, how do they communicate anything that doesn't get perverted by some group?
It's always going to get perverted by some group. You communicate the reality and the facts, and there's always going to be factions that try to distort it and use it to their own advantage. Welcome to the USA, welcome to the world, right? That's just the way it goes. And as founders, as investors, as in mentors, we just got to give everybody the benefit of our experience, and then it's up to the entrepreneur / CEO to take it from there.
Mark, I had a question. It's theoretical, but what does someone like Tesla do who, for example, one of the companies is called Umbrella, and they make chips for the AI vision on the cars, and they're at risk of not being able to operate? What would you do if you're Tesla and you depend on these like smaller tech companies? Would you step in and
so
help
you're saying
them?
A vendor for Tesla is banks at Silicon Valley Bank, and they're at risk of not making payroll?
Yeah, exactly. That's one example. I'm sure there's many. I'm just pointing out one.
Yeah, well, again, it just comes down to what the FDIC does, right? If that advanced dividend is significant enough, like I'll give you a quick story.
What if they don't? Would Tesla ever come? Like, would you ever step in that situation with your own company?
No, I stick, for my own companies, yes. But like I had somebody, my very first company, we're in business 3 years. I was 26 years old. And I had some lady white out our accounts payable checks and write over her name, go to a drive-through, take the money and run, and $82,000 of her $84,000 was gone in about 15 minutes. And I had to call up all my different vendors and explain what happened. And they all understood, and they were all willing to work with me. And I think the same thing will happen here.
So in terms of the larger sort of economic point here, and I know you're not a macro econ person, but just in terms of your own businesses, is this a 2008 Lehman dropping moment, or is it not? I mean, because that's, I think, what a lot of people, regular people, as you were mentioning, are thinking to themselves.
No, because there was a lot of garbage then. Now, it was backed by real estate, but the real estate was so, significantly overpriced that you knew that there were going to be haircuts. We don't know that there are going to be haircuts there. There was just a term mismatch that created a problem when there was a bank run. And if the liquidity is provided to support depositors, it may be that not all depositors even take out their money, right? They may decide that the Bank of Santa Clara and whoever acquires it is a better place to stay. But back then, not only did you have, subprime, which was garbage, signature loans, but you also had derivatives like via AIG where they didn't even know what all their obligations were. And their balance sheets appeared to be effectively wrong. And so I don't think we're that here. You saw Signature Bank wind down orderly. No one's talking about losing any deposits there. And we know what the total risk profile is here. So I don't see this being anything like 2008.
Hey, Mark, don't you think this is a tech wreck 2.0 in the private equity and venture capital market?
Yeah, it all has. Yeah, we're already from March 2000, was, June 2022, maybe. I don't know. I'm picking dates. But yeah, that's what I said earlier. The valuations are declining rapidly. Companies are having down rounds. That's one of the reasons the loan book at SVB was so big, because companies wanted to borrow rather than do down rounds.
Pets.com, how many of them are out there? That's the next question.
Yeah, they're, half of them.
Bingo.
So with all of this, with all of this wreckage in the tech ecosystem, is this going to be good in the long run?
Yeah, of course, because, the Pets.com of the world are going to fail. The current equivalents are going to fail. You saw it in the crypto. Crypto is a perfect analogy because everybody was going to create a blockchain, and on every blockchain there was going to be somebody was creating DeFi, then they were creating an NFT market, an NFT foundation, then NFT marketplace, and then, everybody chased total value locked, and it made it look like you were bigger than you really were. But at the end of the day, there were no transactions on that blockchain that paid anything to the blockchain, and all of that dried up, and all the, since there were no real returns, all that money dried up, and the investment is pretty much dried up. There's nobody chasing crypto investments right now. So it's the exact same thing's going to happen with a lot of these private companies where the valuations were obscene. And since the startups now aren't getting those same valuations and aren't getting funded, you're going to see better companies do better and worse companies not get created.
Interesting. Justin, did you have a question for Mark?
Yeah, and guys, Mark, I got about 3 minutes. Okay, so
Perfect.
This has been fun.
No,
Justin, last question from your end. Go ahead.
Yeah, so appreciate it. Now, there's going to be a lot of incriminations across the board after all the dust settles. What do you think will be the best defenses as to why things failed, whether it's, one of the executives at SVB or whether it's someone at the FDIC? So someone dropped the ball, obviously, or is this just an anomaly? What are the best defenses in this thing that really explain what happened?
Transparency. Because, look, business people make mistakes. So the SVB made the decision to go long-term maturities at the worst possible time. They're not the first company, the first CEO to make a bad decision in the banking industry or any other industry for that matter, and they won't be the last. If all CEOs made the right decisions all the time, the market would be 99 million. There's a lot of mistakes made, and then whenever there's a mistake made, the responses to that mistake dictate the marketplace. And in this particular case, you saw a very clubby industry where they're able to communicate very quickly, get ahead of it, and yank out the money. And so, when does a bank run cause a bank to become insolvent?